With savings rates finally becoming attractive again, it is crucial to understand the difference between a CD and a Treasury bond. A bank CD, also known as a certificate of deposit, is a financial product offered by banks and credit unions. It is a time deposit that allows individuals to invest a specific amount of money for a fixed period of time, typically ranging from a few months to several years. In return for depositing the funds, the bank pays the depositor a fixed interest rate over the term of the CD. Here's how a bank CD typically works. Deposit. The individual deposits a specific amount of money into the CD account. This amount is known as the principal. Term. The individual chooses the term or duration of the CD, such as 6 months, 1 year, or 5 years. The longer the term, the higher the interest rate is likely to be. Interest. The bank pays interest on the CD at a fixed rate, which is predetermined at the time of purchase. The interest can be paid out periodically, such as monthly or annually, or compounded and paid out at the end of the term. Maturity. At the end of the CD term, the CD reaches its maturity date. The individual can choose to withdraw the funds, including the interest earned, or roll over the CD for another term. Bank CDs are generally considered to be low-risk investments because they are insured by the Federal Deposit Insurance Corporation, FDIC, in the United States, up to certain limits. This means that even if the bank were to fail, the individual would still receive their principal and interest, up to the insured amount. The interest rates on bank CDs tend to be higher than regular savings accounts because they require the funds to be locked in for a specific period. However, the downside is that the money cannot be easily accessed before the maturity date without incurring penalties. Bank CDs are popular among individuals who are seeking a secure investment option with predictable returns and a fixed timeline. They are particularly attractive to risk-averse investors who prioritize the preservation of capital over higher potential gains associated with riskier investments. Now let's take a look at a U.S. Treasury bond. A Treasury bond, also known as a government bond or AT bond, is a type of debt security issued by a government to finance its expenditures and manage its borrowing needs. In the United States, Treasury bonds are issued by the U.S. Department of the Treasury. When you purchase a Treasury bond, you are essentially lending money to the government for a specified period of time, typically ranging from 10 to 30 years. In return, the government promises to pay you back the initial amount, known as the principal or face value, when the bond matures. In addition, the government pays periodic interest payments to bondholders, usually on a semi-annual basis, at a fixed interest rate called the coupon rate. Treasury bonds are considered low-risk investments because they are backed by the full faith and credit of the government. This means that the likelihood of the U.S. government defaulting on its bond obligations is considered extremely low. Treasury bonds are often used by investors as a means of preserving capital and generating a steady stream of income. They are also used by financial institutions, such as banks, as a way to meet regulatory requirements for holding safe assets. The market for Treasury bonds is highly liquid and actively traded, and the prices and yields of these bonds can fluctuate based on various factors, including changes in interest rates, inflation expectations, and overall market conditions.